So, once again, good evening, everyone. My name is Yogesh, and thank you so much for joining for today's webinar. Today, we are going to discuss strategies to build an investment portfolio with bonds. We do a lot of webinars week on week basis to discuss about different topics to keep people aware about what's going on with financial markets. And this is something which we intend to do week on week because markets continue to become more and more unpredictable. There are a lot of strategies and research which we do. Of course, every strategy will have its own risk, and that is why it's very important to talk about the risk transparency. It's very important to talk about the previous lows, the previous high, and as per the market situation, how we can progress towards something which is much more market appropriate. That sometimes there are situations with different sets of economies, and how we can, as investors, we can take advantage of those situations, and what is the appropriate form of investment we should pick on. Today's portfolio is much more bond centric, as a lot of investors, they talked about how we can make a portfolio with bonds. There are a lot of strategies again, but today we are going to discuss one or two good strategies where we have seen which seems to be appropriate as per the current market conditions. But as I said, the risks are always there, and we are going to understand that how we can diversify as well. Now, please, if you have any questions, you can use your chat options to ask any questions, and try to use it right now. If you can hear me properly, if you can see my presentation, just write a yes or a okay. Use your chat option to see if it's working fine. And then if you have any questions, you can definitely ask, and I'll be able to answer while even we are in the session, right? If there's a question I'm not able to answer, definitely somebody from my team will reach you out, and will make sure that you definitely understand that how these things work. We'll also have a live platform in, and I will explain it to you that how we will be able to take the trade, or how will we be able to execute a strategy which we are going to discuss about. Now, I'm sure a lot of you already know what bonds are, but some of you may be new in this and want to know how a bond works. So, bond, as simple as very simple as it gets, we call it a IOU certificate. So, bond is nothing else. It's exactly like how a bank would work. So normally, once you loan, or once you borrow money from a bank, once you take a loan, bank has a stipulation to it, right? That you have to return the money which you have borrowed at a stipulated time period, and you have to pay interest, right? You have to pay interest for the time you're using the money. Now, bonds are exactly how a bank process would work. It's just, instead of you being on the borrowing side, you get to be on the lending side. So when you purchase a bond, when you purchase a bond certificate, you are lending money to the person or to the company which has issued the bond, and you earn a certain amount of interest for the time that particular entity is using the money. And at the same time, after a certain period of time, you will get your principal back. This is what a bond certificate says, right? So once again, just to explain to you, there are few parties to the bonds. There is a bond issuer, and there is a bond holder. You, as an investor, are a bond holder, and you are going to lend money to a company, to an organization, or to a government. So let's say US government needs to borrow money from the people so that they can use that money for more economic activities, to build bridges, to build infrastructure, to build real estate. And they will borrow this money from you in a form of a bond certificate. So what they do is they create a bond certificate, and they write that the value of this one bond is, say, for example, $100. Now they will sell these bond certificates to you as an investor. So if you buy 10 bond certificates, you get $1,000. You lend $1,000 to the US government. And for the time US government is using that money of yours, they will pay you annually interest amount. And after a certain period of time, they will return your money back. That's what a bond certificate is. A question just was asked that does that mean it's a guaranteed income? So it's in our line of understanding, we never use the word guaranteed. There is no such thing as guaranteed income or a guaranteed profit. Yes, bonds do provide you a fixed income, right? If you have given loan to the US government, which means if you have purchased a US government bond, you will receive an interest by the end of the year. So, interest are paid semi annually in case of US government bonds, 6 months, 6 months. And once you earn that interest, after 1 year, you have a certain amount in your account, which is the interest. As long as the bond continues until it matures, on the date of the maturity, you get your money back along with the interest which you have earned year on year. So it's definitely a fixed income. Whether it's a guaranteed income or not, that's a point of question, because currently you have given loan to US government. So in our head, it's very difficult to predict that US government is going to go bankrupt, right? Or a government such as big as US or Europe is going to go bankrupt. So it's relatively less riskier. But let's not forget that governments also go bankrupt. Like Venezuelan government went bankrupt, right? There are several governments which went bankrupt. So that does not make bond a guaranteed form of investment income. Yes, you receive a fixed income, and the investments in bonds are relatively less riskier. The word I would always prefer is less riskier as compared to stocks. So once you buy stocks, you're basically investing your money in that company. If that company goes down, so goes down your money with it. But when you're purchasing a bond, you have given loan to a specific company or a country. To use that money, they will pay you an interest, and after a certain time period, they will pay your money back. That's what they write in the bond, which is also known as a promissory certificate, right? Every government every government, so let's say US government issues a bond, it's called treasury. When UK government issues a bond, it's called gilt. When German government issues a bond, it's called bund. When French government issues a bond, it's called oats. Then there are Indian government bonds, there are Japanese government bonds, and all these bonds carry a fixed rate of interest. Some bonds will have a variable rate of interest depending upon when you purchase, you get the entire prospectus on what that interest rate is based on. So central bank, when the central bank loans money to the commercial banks. So let's say here the central bank is the central bank of UAE, and a commercial bank can be ADCB or Mashreq or HSBC. Any bank can be a commercial bank. So there is a central bank, then there is a commercial bank. There is a rate at which central bank loans money to commercial banks when they need it. That rate is the interest rate we are talking about. So when you give a loan to US government, you receive the same interest, which is called the coupon in terms of bond. Currently, the long term or the if I say the interest rate in US government bonds is around 4.5 to 5%. That means that today, if you give loan to the US government, you earn a income of 4.5 to 5% a year. That's the amount of coupon which you get, and that's a fixed income which you earn throughout the maturity of the bond, unless it says that the coupons are variable instead of fixed. Mostly the vanilla bond investments happens with fixed coupons. So you can buy the bond, hold on to it its maturity if you wish to, and earn a certain amount of interest over it. So bonds are for those people here Anybody who is here who is closer to the retirement, 55-year-old, 60-year-old who doesn't want too much adventure in the portfolio, bond investments are there for you. And of course, as an investment consultant, we always suggest a mix of everything. There has to be enough diversification. It's just the allocation of the investments should be in such a way where you get the best of all. So there should be some money into stocks, there should be some money into bonds, there should be some money into strategies. But the idea is, if you're a person who is closer to your retirement and doesn't have another source of income, or is not going to have another source of income very soon, your more allocation should be towards bonds, less towards stocks. Because when it comes to risk, stocks are relatively are more riskier than the bonds. And when it comes to returns also, of course, the returns which you get in bonds are fixed, so it's not as higher as you could get in stocks. So the market risk premium, as we call it, that the more risk you take, you expect a higher return from it. And that is why it's your risk appetite who is going to decide that where I should be mostly exposed towards. So as far as what we understand, bonds are basically debt instruments. These can be issued by governments, it can also be issued by companies. So Apple issues shares. You could buy Apple shares, but you can also buy Apple bonds. It's just Apple, meanwhile, they look for business partners in terms of shares. They also look for people who can lend them money, for which they will pay them regular interest. And after a certain period of time, they will give back the money which they have borrowed, just like any other loan works. Correct? So, bond investments, as I said, before 2020, you would not hear too much about bonds. Reason being that the interest rates, the lending rates, or the cost of borrowing, as we call it, was very low. And during the pandemic itself in 2020, because there was a lockdown and people were losing their jobs, so central banks did not want to make loans more expensive. So the cost of borrowing was very less. So if you would lend money to any government, you will not earn that much amount of interest. In fact, when loans are cheaper, the companies tend to get more and more benefit because they can borrow cheap credit and they can expand and develop. So a lot of people were investing in stocks rather than bonds. After 2021, when the inflation increased, we saw the central banks increasing rates to control inflation, because inflation increases when people have more money in their pockets, their consumption increases, demand for the products increases, but the supply is still not matching up the demand and the price goes up. Now, as good as it feels for the economy, too much inflation hurts a lot, because eventually what happens, people who are living below the poverty line, they're not able to even afford basic necessity goods because the prices are so high. That's why inflation needs to be under control. The collective target for most of the global central banks to control inflation, it's around 2%. In US, around 2021, 2022, we witnessed that the inflation rate reached around 9%, for which in 2022, the US central bank, which is called Federal Reserve, they did aggressive rate hikes, and that led to increase in the cost of borrowing, which brought down the inflation as well, around 3.1%. So from 9%, inflation came down to 3.1%. And the interest rates, the cost of borrowing went up. So eventually, the idea for increasing the interest rates comes from the fact that the central bank increases the rate when they feel that inflation is too high and they need to reduce the money supply in order to bring the inflation down. So they increase the cost of borrowing. So people borrow less because the credit becomes expensive, the loans become expensive. Vice versa, if they feel that inflation is too less, it is inching towards deflation, or it's very low, people are not spending enough money, they make loans cheaper. They reduce the cost of borrowing, so people borrow more money from the banks and they spend, right? So this is the idea behind bonds. Now, next thing, understanding, as I said, what are the features of a bond? Three important things. One is the face value, the value at which bond is issued. So I gave you example in the beginning of this session that let's say one bond certificate issued by a US government bond, a US government, a bond certificate is costing $100. So if you want to lend $1,000 to the US government, you have to buy 10 bonds, one bond being $100 each. So you buy 10 bonds and you are lending them $1,000. The value which is decided by the government or by the issuer of the bond at which they will issue, it is called face value or par value. Okay, so it depends on the par value. It could be $100, it could be $1,000. Next thing is the coupon, the interest which you receive on the money which you have lent to the government or the company. The interest which you receive is called coupon. You receive a coupon on the bond semi annually, 6 months, 6 months. And then there is something called maturity date. Maturity date is that date on which your money will be paid back to you. The lender, the borrower who has borrowed money from you will give you your principal amount back. That is called maturity date. There are bonds which are as low as 3 months maturity. Those are called treasury bills. Uh, Treasury bills also can have a maturity period up to 1 year. There are treasury notes, there are treasury bonds. Some of them have a medium term maturity, 2 to 5 years, 8 years, 10 years also. There are long term bonds as long as 30 years maturity as well. What you need to understand is you can always buy a bond and sell it on the market price if you wish to. So, what will happen is if you have purchased a bond today, if the maturity period is 30 years, you don't necessarily, your money is not locked in for 30 years. You can sell the bond at the market price. But if you sold the bond in 2 years at a higher market price, you will earn interest for only those 2 years. For the remaining 28 years, you don't get anything. So it's up to you. You want to hold on, you want to put your money into a bond which matures in 10 years, you can do that. You want to sell it at a higher market price if you're getting it, you can, but then you will not be receiving the remaining years of the interest rate. So that's your choice exactly how you want to trade bonds. Again, guys, as I said, if you have any questions, please continue to ask. Again, I will be able to answer some questions while we're in the middle of the session. We can clear your doubts. Or again, later on, after the session, also, if you need a one on one understanding of how we use these strategies, what bonds are, we are more than happy to sit with you one on one and we definitely discuss this. Next is the different types of bonds. Now there are fixed rate bonds. As I said, that the bonds can have a fixed coupon. Today, if there are US government bonds which gives you 5% yield, so you buy a bond throughout the 30 years of maturity, you will get 5%. There are floating rate bonds where the coupon or the interest which you receive is variable, changes. For a certain period of time, you get a fixed coupon. After that period of time, you get a variable or a floating rate coupon. There is class of bonds which are called corporate bonds. How corporate bonds work? Companies like HSBC, Bank of America, and all different kinds of companies, they issue bonds. What do you think? If you want, you can use your chat options to write it. Will I be paid higher interest rate if I give loan to US government or if I give loan to Bank of America, a company, for example? Which of these bonds will fetch me a higher interest rate? What do you think? Write your answers, guys. Let's see if you're able to understand this concept. Just try it out. What do you think? If I buy a government bond, will I get higher coupon? Or if I buy a corporate bond, I will get a higher coupon. What do you think? Sorry. Okay, perfect. I see a lot of people started answering here. Okay, so some of you have answered here. A US government bond will fetch us higher interest. Some of you have said the bond which has a corporate bond, let's say for Apple or for Bank of America, So the right answer, I think, okay, I think it's a very mixed reaction. Perfect. See, those of you who have said government bond, it's all about the risk and reward. When you loan money to somebody who has a good credibility, so the chances of US government defaulting on the coupons is less when we compare Apple stocks to it, right? Because Apple is one company, it can go bankrupt anytime. Of course, we know that it is strong, but when we compare Apple, if I give loan to Apple as a company and if I give loan to US government, the more riskier is Apple, right? So the person I'm giving loan to, more risk I take, I should be rewarded more. So the corporate bonds, they carry a higher interest rate, which is called a yield, bond yield. Government bonds have lower yields as compared to corporate bonds, because when you buy a corporate bond, you're taking slightly higher risk than the government bond. Correct? So when you buy a US government bond, it will have a lower yield as compared to a corporate bond. Normally, a lot of investors, they mix. They buy some government bonds, they buy some corporate bonds. So that makes a good portfolio mix for bonds as well. So as you can see, there are corporate bonds, then there are government bonds, then there is something called zero coupon bonds. So the zero coupon bonds are straight away issued at a discounted price. So as I said, the face value of a bond could be 100 or 1000. So zero coupon bonds are issued not at 100 but at a discount of 90. But once the bond matures, it will mature at 100. So you will get that extra 10. But you will not get any coupon at it because coupons are adjusted into the price of the bond itself. So year on year, you will not receive anything. You will receive a lump sum by the end of the maturity of the bond. So that is called zero coupon bond. Then there is something called high yield bonds. High yield bonds are the ones which, so imagine a class of people who you are lending to, but they don't have a very good credit history, right? They are the ones which may give your money back, may not give your money back. So when you are lending money to them, you're telling them that, see, I know you have a bad history, so I'm going to charge a little extra to you. That is called a high yielding bond. A corporate or a government with a bad credit score or a higher risk of default will offer you higher interest. A lot of investors, they mix the risk appetite. Sometimes when they feel aggressive, taking aggressive risk, they will invest into a higher yield bond. They know that in 2 years this particular government might get default or this company might get defaulted, but if it doesn't, then my bond matures in 2 years and I get a higher yield. So again, it depends on your risk appetite whether you want a high yield bond or not. Then there is a convertible bonds. There are bonds which get converted into a stock. So as long as you enjoy the fixed coupon, you're happy. But once you feel that now it's time for the company to do well and their stock might rally and you want to get additional returns, you can convert that bond to a stock. Obviously, you can do that with only corporate bonds, not with the government bonds. So if Apple issued a convertible bond, Apple will allow you to convert that bond into a stock later on. So instead of being a lender, you can be an investor also. Correct? So those are called convertible bonds. Then there are something called inflation indexed bonds. What are inflation indexed bonds? Inflation indexed bonds, the bonds which the coupon or the interest rate of that particular bond matches with the consumer price index or the inflation index. As inflation goes up and down, the interest rate you receive on your bonds also go up and down. So that keeps your investment kind of protected from inflation. So those are called inflation index bonds. There are subordinated bonds, foreign bonds, municipal bonds. Municipal bonds are mostly the kind of bonds which are issued by municipality, the central government sort of a thing. State government bonds. So these are called municipal bonds. For one advantage which the municipal bonds have is they're exempted from alternate city tax, which is a big deal for the US investors at the moment. So a lot of investors, they would invest into municipal bonds as well. There's a question here: who determines which bond is what? So every bond which you buy has a certain prospectus connected to it. If it's a convertible bond, it would say that this is a convertible bond, and it will include all the features that when you can convert this bond to a stock. If it's a fixed rate bond, the bond will say that this bond carries a fixed coupon. If it's a floating rate bond, the bond prospectus would say that it's a floating rate coupon. Definitely, obviously, and then the if you're dealing with the consultants, they will also update you and inform you that these are the kind of bonds which are fixed, floating, or corporate. And I'll give you, I'll show you a portfolio of how the corporate bonds look like and what's their terminology. So I think that should be easier. Again, having a consultant comes into your advantage in all these things. You get to have more and more information, and then you can take your own investment decision. I think the best thing always about having a consultant is just get an idea and you decide what you really like to do. There's a question: do we have any inflation index bonds in UAE? See, it's more like a feature when we talk about inflation index bonds, and I think so. There is a special feature. There are a lot of funds which provide inflation index linked bonds, and there could be a point where the index bonds are available from the government. So you just have to find it. I think you can easily get it. There are a lot of companies which are providing these kind of inflation linked bonds, and these could be US based, and not necessary that this has to be a bond which would be denominated in dirhams. It could be a US bond which is tracking the inflation, and the coupons comes in dollars instead of dirhams. So there are some inflation index bonds, and these are mostly, again, as I said, this is to protect you from a high inflation rate. And we should understand that what is, when we talk about our savings also, whatever accumulated savings we have, uh, eventually, if we don't invest in it, then the inflation eats that up. So there are a lot of bonds which are available, and there are a lot of bond funds as well. Something what we call it as the ETF. If you are aware about the concept of ETF, there are ETFs which provide exposure to a bunch of bonds put into one basket, and all those bonds can be linked to the coupons can be linked to the inflation. So there are, basically the answer to your question is absolutely, there are bonds which are linked with inflation, and there are a lot of companies in UAE which are providing you the inflation index bonds as well, right? And again, as I said, this can happen through a lot of ETFs. So there could be Fidelity based fund, there could be a BlackRock fund which will be providing you an inflation linked bond, and this will something which will give you a peace of mind. So just to tell you also that how inflation linked bonds would work, whatever is the outstanding principal, let's say for example XYZ amount, so the price value of that bond, it rises with the inflation. So there are two ways: sometimes the coupon, it matches with the inflation rate, sometimes the price of the bonds rises with the inflation. So let's say for example, if the bond was issued at 100 and the inflation increased, so the price of your bond can increase to 102 depending on the rate of the inflation, right? So this basically contrasts with the different kinds of securities, because other kind of instruments will decrease in value when inflation rises, but not the inflation linked bonds. So they will be tied to the consumer price index in US, right? Some of them could be linked to the retail price index in UK. So it depends, right? And there are a lot of inflation linked bonds which you can definitely find it. So you can definitely see this. Is it regulated by US Fed Bank? See, US government bonds, definitely it is issued by the US government itself. Please explain subordinated and foreign bonds as well. Definitely. So when we are looking at all these kinds of bonds, right? When we talk about let's say inflation, and when we talk about subordinated, now in terms of a subordinated bond, we are looking at where the bondholder is literally at the bottom of the repayment hierarchy. So, for example, how a subordinated bond would work, it's like a feature. So, imagine the company issued bonds and then call it a subordinated bond, right? Subordinated bond would be that your loan carries the lower importance. So if the company goes into bankruptcy, there are bondholders above you who will get a higher preference. Their money will be paid back first. Your money subordinated. Your money will come back after that. Obviously, if you buy a subordinated bond, you get a higher yield because your risk is higher. So that is something which is called a subordinated bond. And those people who buy subordinated bonds obviously expect a higher yield on it, and that is the only reason they buy it. When we talk about foreign bonds, these could be issued by companies or government agencies. They're issued in one country, but can be offered to investors in other countries and in different currencies also. So, for example, let's say there is a company which is located in US and they issued the bonds, but they're able to offer these bonds to the investors who are into Switzerland and in Swiss francs, right? So let's say a Dubai based company issued bonds, and those bonds are being issued to people in India in Indian rupees. So that is called a foreign bond, right? These are all different kinds of bonds, guys. Again, there are platforms which allow you to find out these bonds. With the help of research consultants, you can find out which bonds will be best to invest into. And eventually, again, it's a game of patience. As I said, see, profits and loss in every investment, that is the part and parcel. It depends on how you calculate your risk. Bonds come at a lower risk category as compared to stocks or cryptos or commodities kind of investment. But when it comes to bonds within each other, obviously a high yield bond would carry a higher risk than a lower yielding bond. A corporate bond carries a higher risk than a government bond. A company which is in US versus a company, let's say uh, in Venezuela, right? So the Venezuelan company will have a higher yield because the risk is higher. So it depends on what kind of bonds are available and where the economic situation is. So at this point of time, maybe the inflation index bonds are one of the best to work with also, right? So this is how the bonds normally work. Now coming to the idea of a bond yield and curve, you will hear this word bond yield a lot of times. See, bond yield is nothing else, it's the total return which is expected out of the bond once it matures. So let's say if the bond is issued at a price of 100, it is expected that the bond will get mature at a price of 100. So just remember this thing always. If you have purchased a bond for $100, by the end of the maturity you will get back $100, correct? In before the maturity, if the value of that bond goes up from 100 to 105, you can sell it, but you will lose the interest on the rest of the years because you have sold that bond. But if you hold on to the bond till its maturity, so you lent $100, you will get back $100. Doesn't matter what is the market price during that time. If your bond matures, you will get the money, the par value at which the bond is issued. Except the fact, if the bond you purchase is for $90, which is less than 100, less than the face value, again it will be maturing at $100. So the bond always, this maturity time is called redemption of the bond. So bond which is issued at par will always redeem at par. Par value or the face value or the nominal value is the value at which bond is issued. If US government has issued a bond at $100, 10 years bond maturity, after the maturity of 10 years you will receive $100, right? Along with the coupon year on year which you get. Now, how bond yield works? Bond yield is the total return on the bond. As of now, what we have understood, you can get one kind of return on the bond, and that is a coupon interest rate. So, if I say that you will receive 5% interest, the 5% is the bond yield, right? But let's say a bond which is issued at 90 and will be redeemed at 100. So you will get a coupon on it plus you get $10 extra. So the bond yield is slightly higher than the coupon because you are getting a little extra. Yield is what? The total return on the bond till its maturity. So when you make something on the capital gain, right, and along with the coupon, the bond yield slightly increases. right? How a bond yield curve works. So in this chart, what you see is the maturity period. On the horizontal axis are the periods of the bond. A 1 year bond, 2 year bond, 5 year bond, 7 year bond, 10 year bond, 20 year bond, and a 30 year bond, if you look at the chart very clearly. The vertical axis shows the yield or the return on the bond. As you can see, the bond curve is slightly bending upward sloping, right? Why it is? It shows that a 1 year bond has a lower yield, but as the time progresses, as the maturity of your bond increases, the yield also increases, which means the higher or the longer term the bond is, more sensitive it is to the interest rate changes. The price moves more, it is more sensitive if it is a longer term bond, and the yield is slightly higher than a in a longer term bond. Why it is that? Very simple. If you give loan to somebody who tells you that I will give your money back in 1 year, you ask him for a rate of interest, say 2%. But if you're giving a loan to someone for 30 years, you will ask for a higher rate of interest because you know that you are not going to get your money in the next 30 years. You will get it only after that. That is too long a risk. So that's why you would charge more to the person who has your money for the longer time. Correct? That is exactly why a bond yield curve is upward sloping, right? Because starting from the lower maturity to the longest, the yield also goes like this. The longest maturity should have a longer or a higher yield. Sorry, not a longer yield, but a higher yield also. That's how the bond yield and the curve works. One thing which I want you to establish, write it on a piece of paper if you want, it will really help you out. A longer term bond, something which is 20 to 30 years or 25 to 30-year bonds, is more sensitive to the interest rate changes, which means today you're receiving 5% interest rate on a US government bond. What does it mean? It means that you have given loan to US government and US government is paying you 5% interest. Because it's a bond, it is mentioned in that certificate that you will receive 5% interest rate for the next 30 years. So if you hold your bond for 30 years, you will be paid 5% year on year. Correct? Now the question is, what happens when the cost of borrowing reduces in the market? If the cost of borrowing becomes 3% now, your bond is still paying you 5% because the bond was created and it was promised that you will receive 5% coupon till the bond matures. Suddenly your bond becomes very valuable to the outsiders because outside the interest rates are just 3%, while you receive 5%. The price of your bond increases in the market, which also brings us to another question. When the interest rates come down, the bond prices go up. Please write it on a piece of paper if you can. This will help you to understand the rest of the strategies. If the interest rate comes down or if the bond yield comes down, the prices go up. If the interest rate goes up, which means the bond which you have is giving you 5%, but in the market interest rate is 7%. Now the value of your bond diminishes, starts coming down because in the market the interest rate is much higher while your bond just pays you only 5%. So your bond price comes down. So this is how the inverse relationship between a bond price and a bond yield or the interest rate works. If interest rates come down, the bond prices go up. If interest rates go up, bond prices they come down, right? Please write it on a piece of paper. So the next strategy which I'm going to discuss is clearly based upon that idea and followed by points to know. Bonds can be issued by companies or governments. They generally pay a stated interest rate. The market value of the bond changes over time as it becomes more or less attractive to buyers. As I say, as the interest rates go up or down, it depends on the interest rates that the price of the bonds can go up and down. Please be very clear with it. If you purchase a bond which has a maturity of 10 years, you can hold the bond for 10 years. The price at which the bond is issued, it will be redeemed at the same price, which is the face value. Okay. It doesn't matter what is the market price of the bond always gets redeemed at par value or the face value. If you have purchased a bond and the value of the bond has gone up, you can easily sell the bond at the market price and earn that capital growth, but you will not be paid the interest for the remaining years because you have already sold the bond. So that's your choice what you need. Bonds that are higher quality, which most likely are to be paid on time, offers lower interest rate. It's just like that. You loan money to somebody who has a good credit history, everybody will be able to loan to him because they know their money is coming back. So the interest rate to them will be less because your risk is less. But to somebody whom you are paying who doesn't have a good credit history, you're going to charge them more because your risk is higher. So bonds that have shorter maturities tend to offer lower interest rate. Just what I said, that if you are giving loan to somebody for a uh, lower duration, your yield is less. But if you are giving it for higher duration, your yield expectation is higher. So the higher, longer term maturity bond has, more sensitive they are, more sensitive their prices are to the interest rate changes. Now, coming to the main agenda, which is bond strategies. Now, there are different bond strategies which can be used. Most importantly, the current, which we have been talking a lot about, is Eurobuxel. And I'm also going to share a portfolio of investment grade corporate bonds. So you can see the difference between the US government and corporate bonds as well. And please keep this thing in mind, what I just told you, that when the interest rates come down, the price of the bond goes up. Now, the strategy which I'm going to discuss about, the last one, which is called Euro-Buxel strategy, something which we have been talking to a lot of clients, and we have been discussing about. I'll also show you how to place the trade in the live platform using the Euro-Buxel. Please understand this. The strategy which I'm going to tell you right now, this is for your information. Please do not take the trade right away without consulting to a proper risk manager. These strategies are not risk free. None of the strategies are. What I am telling you is for your information. The strategies can be in a loss for some time, can yield to profit, depends on how the market situations work. So please do not jump onto the strategy unless you discuss it with your risk consultants. Once you know the risk, only then try it out. Until then, just hear what it is. And for a more explanation, you can always reach out to us and we can definitely tell you how to work with it. I'll be very quickly sharing my screen with you so I can show you the flyer also here. Meanwhile, please, if you have any questions, just let me know and I'll be here able to answer. Perfect. Okay. Okay. Right here. Now, what you see is, please just give me a thumbs up or a okay if you can see this PDF clearly. You want me to increase it, zoom it more? If you're able to see it properly, just give me a yes or okay. It's a very important strategy, guys. It's one of the most important agendas. In fact, I wanted to discuss today. So if you can see this properly, please give me a yes or a okay, and that would be very helpful, and I can proceed. Okay, right. Okay, okay. Perfect. So I think a lot of you already have said yes. So I'm assuming that it's clear. If in between you miss out on something, just let me know. I'll definitely repeat this for you. Now, the let's understand word to word what these products are. I have talked about bonds, said that there are a lot of bonds issued by US government, by UK government, by European government. Within Europe government, there are different countries. I'm talking about Germany. The Germany government bonds are called bunds. Okay. Eurobuxel is a basket of these bunds put together, just like a fund. Okay. Eurobuxel is, so let me show you right here, and let's study the flyer here. Let's understand what is Eurobuxel. The Eurobuxel natural complement to the European Union bonds market, offering traders and investors a direct means to manage their long-term interest rate risk and portfolio duration. What does this basically means? That Eurobuxel is like a basket which has a lot of euro bonds whose maturity is mostly 30 years. All right, 30-year bonds which have a 4% coupon, 4% interest rate, right? Now, all these European bonds put together, but these are longer term maturity bonds. Please understand this, longer term maturity bonds. In this, what we are looking at, first of all, as the previous nature of the bonds, as we have understood, if I buy a bond, I get a coupon, right? The one which I am sharing it with you right now is a derivative. It's a basket of bonds. So when you buy that, you don't receive any interest on this. Okay. It's like a basket where most of long term 25 to 30-year bonds are put into that basket, and the value of that basket goes up and down on the basis of the market forces, and we'll understand what are these. But please be very clear that when you buy Euro Buxel in your trading platforms, you're not paid any coupon because it's just a derivative. It's a the underlying asset is the European bonds, but it is in a form of a CFD. It's in a form of a derivative. As I said, for more understanding what is how a CFD works or how a derivative works, we can always sit and discuss more. But in this kind of bond, you're not receiving any coupon. In fact, this strategy is more of a play on the increase or decrease in the prices of the bond, and I'll explain you how. So let's understand the Eurobuxel is a basket of European German government bonds we have, which are put into this, and it carries a price. So currently, the price of the bond would be around 131. It was somewhere around 134 euros when we started talking about it. It has come down recently around 131 euros. Let's understand and see in last 10 years what has been the lowest. So if you see this chart for Euro Buxel, right? If you see this chart, this is from 2013. The lowest it has gone is somewhere around 118 right here. If you see, let me read this out for you. The lowest recorded price was 119 euros, which was in 2023. Highest has been around 228 euros, which was in 2020. Now the euro buxel reached to a lower end, which is 120 to 125 eurozone, presents a promising opportunity with the next significant resistance up to 160 or 170. Resistance means from where the price can touch and come down, right? Before it reaches to 200 or the idea. So the chart which you see is of the euro buxel basket, which has European bonds in it. The price is 131 euros currently. It was 134 euros when the strategy came out. The prices have come down a bit, but the highest it has seen was in around 2020, which was more than $220. The lowest it has seen is around 190. So currently it's in that down range between 130, 125 to 130 euros. And that is where it became a very promising opportunity because it is giving you the exposure. First of all, it is giving you the exposure in the German government. A lot of you must have seen that Germany dipped into recession in last 1 year, and the reason was the inflation which increased in 2022 in US, in UK, in Europe also. The central banks they increased the interest rates. In my earlier discussions, when I was telling you that to control the inflation and to bring it down, the central banks they tend to increase the interest rate, so loans become expensive and the cash reduces so that people consume less and the price starts falling, so inflation comes under control. When Europe did that, it pushed Germany into recession, right? So the interest rates for Europe especially went to almost 4%. The deposit rate went to 4%. The long term lending rates around 2.9, 2.1% for the German government. And now what we have seen is that it has been last three central bank meetings and the European Central Bank has not increased any further rates. First, they are not in a position to do it because any more credit rate increases, it might bring uh, the economy further down because Germany is already into recession and it's one of the most important economies in Europe. Now, we did something called a regression analysis, which basically was done to understand the relationship between a 30-year German government bond along with the price of Eurobuxel, right? Which, when the analysis done, represents a very inverse relationship. It shows that if the interest rates, if basically the German government bond yields, when the German government lending rates comes down, the price of the Eurobuxel goes up. As we have seen when we were establishing this relationship, that when interest rates drop, the price of the bond goes up. Why? Because the current bonds which you have a higher return. But when the interest rate goes down in the market, your bond becomes more valuable. So the Eurobuxel prices go up. Similarly, what we have seen a decrease by 0.5% in the German yields, which is expected also because currently, if the loans are expensive in Europe and the Europe is in recession, they will have to make loans cheaper. And of lately, the deposit rates have been around 4%, which is highest in last 18 to 20 years in Europe. The deposit rates are at the highest. When deposit rate is highest, what does it mean? When deposit rate is around 4%, it basically means that the central bank discourages people to spend more money, rather tell them to keep it in the bank, so we'll give you a higher deposit return. And why they discourage them to spend more money? So that the consumption is less, demand is less, and the price of the product comes down to control the inflation. And that deposit rate has gone to 4%. Now, if they make deposits more attractive, people will stop spending. And at this point of time, it is needed that the people in Europe will spend more, because eventually the Europe is into recession and the economic activity has reduced. So it will be not the right thing to increase any more rates, but rather cut it down. When interest rates are going to be cut down, the price of the bonds expect to go up. The analysis which you see right now is based on a regression sort of analysis, and a regression analysis gives a kind of relationship, a confidence interval. I know I'm saying too many words which are heavy at this moment. Just to make it simpler for you, this relationship shows, this analysis shows a inverse relationship between Eurobuxel prices and the German government bond yields. If the yields come down by 0.5%, the expected increase in the Eurobuxel prices was around 10%. If the yields come down by 1%, which is 100 basis points, as you can see, 100 BPS, 100 basis points is another way of saying 1%. So 1% fall in the yields could lead to 20% increase. On the downside scenario, if Europe decides to increase the rate even further, which is not advised at the moment, but if they do, an increase of 0.5% can bring the Eurobuxel prices down by another 10%. An increase by 1%, which is highly unlikely, can reduce the price of Eurobuxel by 20-21%. Correct? Now, move on to the other part of this. Once we have established the relationship, what is next? The next thing is, let's understand the scenario analysis. Instead of looking the amount ahead, yeah. Let's understand the path for European Central Bank. They maintain the interest rate steady at 4% as per the January meeting. And this was the third time when the European Central Bank, they kept their deposit rates at 4%, right? Now this was something, the last it happened was until September 2023, when it was around 4.5%. Now Eurozone economy has stalled. There is a threat of recession looming over it. The German manufacturing has come down. It has contracted 7th straight month. The price pressures in the Eurozone are abating at a faster pace. Inflation rate has declined to 2.9%. The Euro area inflation had been above 10% in October 2022. It was at 8.6% in 2023. So inflation has dropped in last few months. It is still expected to rise modestly due to the increase in the oil prices, And again, let's not forget that the Russia-Ukraine war is still on, so Europe is the neck is out in the Russia-Ukraine war. But we still expect a lot of downward trajectory. So the average inflation will be around 2.7% in 2024, could go down by 2025, and then further to 1.9% in 2026. This I was telling you, look at this green part, the deposit rate. Since 1999, this is the highest rate which has peaked at the moment. Another reason that why we must expect the Europe not to increase rates any further. This is at the highest, and Europe is into recession at the moment. So the rates should be coming down in the next few meetings, and a decline in the interest rates should mostly push the euro buxel prices higher, is what the analysis is about. Currently, the euro buxel price is still down because the interest rates are still at its peak. So you buy, if you have bought at 134, 135, it is in 131, would still suggest hold on to it. You have purchased, if you haven't purchased, you want to go for it, please understand your risk first. If you're able to take that amount of risk, a decent opportunity to enter. What exposure you are getting when you buy euro buxel, you are exposing yourself to the German government, right? Germany was one of the most important manufacturing or one of the most important economies for Europe. So your exposure is to the German government, right? Unless German government uh, says that we are defaulting, right? Only then that's a bad news for investment. But till now, at this moment, the price of euro buxel goes up and down on the basis of the interest rates. Interest rate changes once the rates get cut, the sudden increase in the price is expected. But as I said, no investment is away from the downside as well. That's why I gave you both the scenarios. If there is a time that instead of cutting down the rates, the European Central Bank starts increasing the rates, at this point of time, when we see Europe from an analytic perspective, it is not expected because they are going through recession. There are a lot of price pressures, and at this moment, it will be not the right step to increase rates anymore. Rather, to cut it down to improve the condition of the economy, makes loans more cheaper, reduce the deposit rates so that people can take their money out and spend more, or that's the idea. So that is where you can get an advantage by investing in the Eurobuxel. And most important part is it's a very liquid sort of a investment. You buy Eurobuxel today, you can sell it the very next second if you want to, if you get your price. So it's not something where your money gets stuck at a certain level. So you can always buy and sell using an online platform. And very quickly, I'm going to show you how to do that right away on the platform once we finish this. Another important part, let's see what happened in the financial crisis. It has happened before. In 2008, during the month of June, the German government bond yields are around 4.8%. When the recession hit, it was only suggested for the European Central Bank to reduce down the interest rates, right? Because the recession came in. So if you see, in 2008, when the German government yield was 4.8%, the euro buxel price was 86 euros in 2008. The moment the yields were cut down in the next 6 months in 2008 from 4.8% to 3.5%, the price of Eurobucks increased from 86 to 102, a interest rate increase of 18.5%. So this is what we have seen back in the past. During the financial crisis also, when German government bond yields were reduced almost by 1.3%, the price of Eurobuxel went up by 18.5%. So on those premises and on the regression analysis, the expectation is that when the German government bond yields will start coming down, or when there is a rate cut happens, the euro buxel prices are expected to bounce back. So now it is up to you how much exposure you want to take. So here we put both the scenarios, with leverage, without leverage. I would obviously, from a less riskier perspective, no leverage is the best form of investment. Never encourage yourself to take leverage. Anybody who wants to have a moderate risk appetite, not too conservative, not too aggressive, or 2 times leverage may not be the worst idea. But again, you need to have the risk appetite for that. A no leverage kind of an investment is something which could be the best idea. Just to give you the scenario over here, if let's say you have put, again, you can make changes up to you yourself. This was done for $1 million, for example. So if you have invested $1 million and you purchased it at a price of 130 euros, so you have bought 1 million euros, you have put $1 million in it. The number of units which you will purchase be around 6,900. If the price goes up by 10%, potential profit $100,000. If the interest rates come down by 1%, an increase of 20% is expected. If the rates go up by 50 basis points, you are going to lose that much amount of money. I want to make too much stress on the point where I say lose, so that you understand that this is not a risk-free investment. There is always a chance that you might be losing money in this, but the volatility part is slightly less as compared to the stocks. And again, that's why we have US data has come out. The inflation in US in last month was slightly higher. So all the rumors about rate cuts in US, they have fizzled off. So the chances of US government bonds going higher anytime soon is less as compared to Europe. So that's why the Euro Buxel is a more appropriate opportunity. The question, I have invested in Euro Buxel at 140 average, presently net loss. Should I average at 130 now? Yes, patience is the name of the game. See, again, here on this particular session, me recommending you a trade is not advised. If you have purchased at 140, this is not a bad price to average, but please check your risk appetite first. I'm assuming that you have not taken any leverage. If you haven't, this will not be the worst price to average. I think 130 is a decent enough, it's a good price. If you wish to, you can, but please talk to a consultant before you do that. On this particular platform, I would refrain from recommending any trade. Yes, this is a very attractive price, and I would suggest whatever investments you do, please don't take leverage, and definitely calculate your risk. See, the lowest which we have seen is around 118. So please calculate your risk at least as per the historic low. Be ready that, okay, if I average at 130, my average price will be around 135. So from 135, if it hits a historic low of 118, how much loss I'll be at? If you are ready to take that loss, no problem. If you are not, then just, I'm assuming it's always good to be patient, because the rates we have seen historically, even in case of US central bank as well, whenever a rate hike cycle has started, eventually rates have come down. uh, yes, it takes some time, but it depends on the condition of the economy also. Currently Europe is under a lot of stress, so there is no motivation for the rates to go up. Definitely a rate decline is anticipated, but until that happens, we will see fluctuations in euro buxel as well, right? Another important thing here, so I'm showing you both the scenarios. Any investor interested in taking 2 times leverage, your returns will be magnified, your losses will be magnified as well. So please take that decision. It's up to you how you want to do it. This is just one form of investment. This is in Eurobuxel. Real quick, before I place the trade and show you how you do it on the platform, let me just do it right away, so you will get an idea of how we actually do this. So let's say this is the live platform right here. Let me see if you can see this right now. I'll just zoom in so everybody can see while we are able to place the trade here. So very simple. Here you search, let's say Eurobuxel, Eurobuxel cash. See, if you see the current price is 132. Right here, 132.5. If I were to see a chart in last few months, right here, if you see, look at this. Okay, so I'm showing you a chart here, 2023 beginning at the moment. Look at this. It was in 2023, sorry, 2022 May, it reached around 180. In October 2023, it was around 118. It went up to 140. It is around 131. And if you see this, this is the current price right here. Okay, so be ready if it falls down to this, but if it does, it will not be one of the historic lows, again a good entry point to go for. And it's a bond, so it's not like a stock. It's normally we see that the movement is not that fierce, how a stock could move 10-20% a day, because it's a exposure on a German government, many different long-term European bonds put together into one basket, right? So how you take the trade? Click on buy, you get your order ticket, decide whatever is your exposure. If it is $100,000, write 100,000. You will get a quantity, let's say somewhere around 700 units, $100,000. Confirm, place your order, and it's done. So you bought 700 units of Eurobuxel at 132. If it comes down to, let's say, 120, $12 loss in 700 units. That means almost a loss more than $7,000. So on a $100,000 exposure, if it comes down to the historic low, you might end up losing around 10% of that capital. So you be ready if it reaches to the historic low. Again, will not be a worse idea to buy at the dips, but please calculate your risk appetites and only then do that. Different investors have different time horizons. If you need the money in another 2 months or 3 months, then it's a different ball game altogether, because this strategy works in a very different manner. It depends on the condition of Europe. It depends on how the central bank is going to react. Again, we'll see how the condition improves or if it doesn't. So all these are, there is a lot of ifs and buts. But then every investment portfolio, that's why diversification is the key. While, so since we are talking about it, while we talk about how we invest into Eurobuxel as a strategy, you can also look, you can buy US government bonds, which are giving you a decent amount of yield at the moment. And also, something which I have shared with a lot of people back in the past, a corporate bonds portfolio as well. As I said, the US government bonds gives you around 4 to 5%. Then there are a lot of corporate bonds as well, whose yield to maturity could be around 7%, could be around 8% as well. And these are issued by the companies like HSBC, Citigroup, SocGen, Barclays, Bank of America. And if you see their yield to maturity is around 8%, 8.4%, 8.3%, and they're available at a discounted price at the moment, and the ratings are triple B, Baa2. Most of them are A minus, A plus. The ratings are decent. Some of their maturities are, some of them are perpetual. Some of the maturities will happen in 2028, 2029, 2033. Some of them are perpetual bonds, which means they never have any maturity, it goes on. Some of them are callable bonds, which means the issuer can redeem the bond at a specified time period. So few bonds are callable, which means at 2027, 2028, the issuer has the option to call back the bonds and give your money back. So currently you can buy a lot of medium term US bonds as well, right? And do the Eurobuxel strategy and do the corporate bonds. This is how a typical bond portfolio can be developed. While Eurobuxel will bring some adventure, the prospects of risk and reward are also there. And looking at the condition of the Europe, looks like an appropriate product to look in. That being said, please sit with us, talk to us how much money you want to invest. Please talk to us about the risks as well. We will definitely want to show you both the scenarios. It's an opportunity, it has its own risk and rewards. So please sit with us, talk to us. You can definitely have the platform, and you can definitely try. Somebody asked the question that if can we have this demo platform where we can try to just put the trade and see where it goes. You can, definitely you can. The product is available, demo account is available. Just reach out to your relationship manager, and they will definitely tell you how to even execute the trades. Our office is in Emar Square. If you wish, please come down to our office, sit with us, and we'll explain it to you how to use the platform and how to execute the trade and what are the risks you're looking for. You can do it with as low as 10,000 or $20,000, also or 100,000 or a million. It's up to you. Whatever your risk allows you to. At the end of the day, we always would suggest you to have a very diversified approach towards your portfolio. Don't exhaust all your savings to put into Eurobuxel. Not the right thing to do. Always have a mixed exposure in all different asset classes and in different forms of strategies as well. Right. So thank you so much, guys. Once again, it was a great time discussing with you. As I said, that whatever we have discussed over here, I'm definitely available for a one-on-one session. We have our consultants and analysts ready to talk to you. Please come to our office. Understand if you have any questions. If you have already taken trades, you feel that do you want to average it? Please talk to the risk consultants and just ask how low it can go, and then calculate that are you ready to take that much amount of risk or loss in that portfolio. Because when it comes to investments, the biggest risk is to be not invested in any asset class. I meet a lot of people, and sometimes they say that markets are not right, I would rather prefer keeping cash with me. See, keeping cash with you in an inflationary period, it's definitely not going to help. So we have our own risks and rewards, but the only thing is risk needs to be calculated. High or low is one thing, but risk needs to be calculated. So calculate that risk, sit with us, will help you to understand that. And please, if you like the webinar, review us on Google Century Financial. And we continue to do these sessions every week. And we encourage more and more participation. Next week, we'll come up with a different session, with a different product, with a different strategy. And I would be more than happy for this one. Please, if you want to come to my office, sit with us one-on-one and just have a chat. Absolutely. Whether you have an account with us or don't have an account with us, please come and chat to us, and we'll definitely give you every knowledge we can over here. So once again, thank you so much for joining tonight, guys. The entire 1 hour passed, and I did not even see my watch until now. So it was a great time. Thank you so much for your questions. And if you have any doubts, as I said, please meet us over a cup of coffee in Emar Square. My name is Yogesh. And once again, you have a good night, and we'll see you next week.